Hello, Dan Joss. How are you today?
I'm doing well. How are you?
I'm doing well, thank
Good.
you. So, I understand we're going to maybe discuss a little shaken, not stirred
Sure.
bond.
Bond. Bonds and interest rate risk.
Okay. Well, tell me all about that because I know very little about that. I know a little bit about the James bond, but not the bond and interest rate risk.
You know what a bond is? We've talked about that before.
Um,
That's when we
yes.
loan a company money
Uh-huh.
in the form of a bond. We buy their bond, which means we loan them money. Then we get interest payments a couple times a year. And then after a period of the term, we get our principal back, which is what we gave them.
At least you hope you get the interest payments along the way
Well, government bonds are low risk.
because
Therefore,
the governments usually don't go out of business.
right. The federal government has the ability to tax, and so we'll get our money back. But as you can see now, it may be less valuable
Right.
because they can affect the value of the dollar.
Okay.
A corporation that, like a Coca-Cola bond or a Pepsi bond or a Ford bond, pay a little bit more because they don't have the ability to tax.
True.
They have to pay back the interest with profit they have, right? So to compensate for that risk, they have to pay the investor a little bit more.
Okay.
And then you could pick a bond like a country like Puerto Rico or Greece, where they're considered higher risk.
Mm-hmm.
And the bond industry calls those high yield bonds because the yield is the payment.
Oh, yeah, they want you to focus on the yield,
Right. So
not the risk.
others call them junk bonds.
Okay.
You'll get high yield, but you may or may not get it for long, and you may not get your principal back.
And it may just turn out to be junk.
That's right.
Okay.
So there's two sides of every coin.
Of course.
Interest rate risk, though, as we get back to that, is once I have a bond, if the interest rate changes, and regardless of the risk in the bond itself, the risk of the principal, the value of the bond changes because the interest rates have changed.
I would have figured that they were at a fixed rate.
Well, the bond is, but when the interest rate changes in the real world, the value of what I have can appreciate or depreciate.
Yes. Okay.
So
I'm with you
if
on
you
that.
buy a truck, the truck doesn't change, except when the new trucks come out, your truck is now worth less than it used to be because it's old and there's newer stuff out.
Yeah.
Okay,
That's
so
true.
it's the same with the bond. Well, this year, as the Fed increased the interest rates, people saw what risk is,
Okay.
and the value of what they had goes down because now interest rates are higher. So I'm not happy with my 3% bond if I can get a 6% bond.
Right.
So the value drops. And I had some new clients come to us recently, and so I get to see what they have with another advisor or themselves doing their own investing. And I saw bonds. I printed off a list here, and you can see it, but they can't. Maybe 10 or 12 bond funds by a well-known company, and they're just buying the bonds according to their charter. And it could be a short-term high-quality bond. It could be an intermediate-term corporate bond. It could be a mortgage-backed security. It could be a high-yield extended duration bond. This is a federal bond fund. Guess how much it's down this year?
50%.
41%.
Wow.
And people usually buy bonds because they think they're safe. Well, it's a federal bond, so you'll get your interest payments. But the current value, because of the interest rate changes by the Fed, have taken half of this value away.
Wow.
And that's not the stock market. That's the safe bond market.
Right. That's the safe bond market. Not so safe.
International bonds down 11, corporate bonds down 15. The bond market as a whole down about 14%. Short-term bonds, I'd mentioned they were a little safer, down 5%. TIPS, Treasury Inflation Protected Securities, down about 3%. But extended duration Treasury down 41. Long bond corporates down 28%. Long Treasury down 30%.
That's substantial.
So that's interest rate risk.
Interest rate risk.
So when we make recommendation of invest, we like high quality.
Right.
So we don't want to take principal risk. So we're not going to invest in high yield. And we like short and intermediate.
Okay.
And so when this new client or several new clients come to us and we see long bonds or high yield bonds, we tell them what we're going to recommend and why it's different than what they have.
Okay.
And another advisor may recommend this, and they say, this is suitable for you. Here's what we're going to do, because we're going to diversify in the bond portion of your portfolio. That's a reasonable goal, but we diversify, but we kind of stay away from interest rate risk and principal risk.
Okay. But ultimately, it's the client's decision. You're advisors.
Sure.
Yeah.
Sure. We're advisors. Some clients take our advice and some clients don't. Some clients don't care. They
Right.
trust the advisor. But we'd recommend everyone look at their portfolios and see that they understand what they have and why they have it, and realize the risks that they're assuming when they do something themselves or take their advisor's advice.
That's good. One of those pieces of advice might be to give you a call, and they can have that conversation with you personally.
Yeah, they can. We take a call. We talk for 30 minutes. See what you need, how we can service you or serve you, and you can call us at 757-903-2127, and our website is jossbrown.com.
Excellent. Thank you so much.
Thank you.